Hello everyone, this is Parthasarathi and today's topic is capital structure. First of all, we'll discuss about what is capital. As capital is the money or the wealth needed to produce goods and services. In simple sense, we can say that a company need money. Why the company need the money? Company need money to start a business. To run the business, a company needs money. There are different sources of money. There is a different source of capital. It may be a long-term source or short-term source. But we consider only long-term sources of money as the capital. Okay? In the most basic terms, money in all the business must have capital in order to purchase assets. If you want to purchase any building, any machinery or any asset, we need money. And to maintain the operations, that is, in order to run the business, we need the capital. Okay, business capital comes into two main forms, that is two main forms of long term sources of finance, that is debt and equity. So we can simply say that capital is the amount of money which is required by the business to start a business, to run the business, for all the operations of business. We need the money. That money we call it as capital. That money we call it as capital. Okay. Then coming to, it simply says that capital is the association of capital assets of the company that require a significant amount of capital to finance or to expand. So we can simply say that capital is the long term sources of money which is required to start the business, to run the business. We require the capital. Okay. Then coming to capital structure. Capital structure. See, we can simply, we'll go for simple example. We have a pen. The pen consists of ink, plastic, rubber, a nib with iron. These are all comes under the structure of the pen, is it not? If you combine all these things, we call it as structure of the pen. In the same way, I'll go for one more example. If you are coming from home to a hostel or to a room, your father gives some money, your mother gives some money, and your brother gives some money, right? All this money is combined, we call it as capital. We call it as capital. And the capital structure refers to what is the proportion of money that your father has given to you, and what is the proportion of money that your mother has given to you, and what is the proportion of money that your brother has given to you. We call it as capital structure. Okay, right. Now the capital structure in a company is simply a combination of debt and equity. Okay, now let us see what are the various sources of long term funds. First one is proprietor funds, that is own funds. Own funds, that is investors, that is owners fund. We call it as proprietor funds. That is equity capital. That is, in for capital structure, the investors will give the money in the form of equity capital. The equity shareholders are the real owners of the business. They will enjoy all the profits of the business, and as well they will bear the losses of the business. They have the voting power in the business. They are the owners of the business. Okay, that the capital, the money which we generate from the equity shareholders, we call it as equity capital. Okay, and it is a long term source of money. Then coming to preference capital. What is preference capital? Preference capital, the term itself says that preference, that is while paying dividends to the shareholders, while paying dividends to the shareholders, the company will give first preference of paying dividend to the shareholder, to the preference share capital holders. Okay, then and this preference capital is a fixed portion of the capital, that is it will give fixed percentage of profits to the shareholders, that is called as preference capital. Okay, that is, in simple sense we can say that, but this preference shareholder doesn't have the voting power. Only equity shareholders is having the voting power. Preference shareholders are given preference in the while paying the dividends, and preference shareholder, the dividends are paid in the fixed proportion of the profit. Okay, then coming to reserves and surplus. Okay, reserves and surplus is nothing but a company is having some portions of reserves, that is from the previous earnings, earnings, and surplus of money the company which have, we call it as reserves and surplus. Okay, coming to proprietary funds, that is in simple sense capital, that is the source of money the company will get in the two different forms. The first one is proprietary funds, which consist of equity capital, and the second one is preference capital, and the third one is reserves fund. Then coming to borrowed funds. Borrowed funds is nothing but the company will get borrow money from the outside in the form of debt. It may be bank loans, it may be loans from the financial institutions, it may be in the form of debentures, or it may be in the form of any forms of bonds which are in the form of long term source of funds. We call it as long term sources of debt. We call it as borrowed funds or long term source of funds. Okay, this is the various sources of capital. Okay, next coming to the meaning of capital structure. The term capital structure refers to the relationship between various sources of financing such as equity capital, preference capital, and debt capital, which says that this capital structure will shows the relationship between the long term source of finance, that is what is the proportion of debt, what is the proportion of equity, and what is the proportion of reserves and surplus, and what is the proportion of debt capital, how they are related. Okay, this means this is this simple form meaning of capital structure, that is it shows the relationship between the various sources of long term funds. It shows the relationship between various sources of long term funds of capital. And then coming to capital structure proportion between various long term source of finance in a total capital of the firm. Okay, then coming to a financial manager chooses that sources of finance which include minimum risk as well as cost of capital. That is, it says that the financial manager has to select an optimum capital structure which will, it decreases the risk and which will increases the value of the firm. That is the role of the financial manager. See, as there are different sources of long term source of finance, we have equity capital, preference, reserve surplus, and long term and debts. We should not we have to, while going for preparing a capital structure, we have to consider all the risks associated with the sources of funds, and then we have to select our capital structure. So the financial manager will chooses the source of finance which will minimize the risk and as well as the minimum cost of capital. What is the cost of capital? Cost of capital is nothing but the cost which is incurred to raise this capital. Cost of equity, cost of preference, cost of debentures, cost of reserves and surplus, these are all comes under, if you combine all these things, we call it as cost of capital. That is, for example, if you purchase a pen of worth of 10 rupees, we call it as cost of the pen, is it not? In the same way, if you purchase the capital, if you get the capital into the business, we call it as cost of the capital. Okay, and the capital consists of debt capital, equity capital, preference capital, reserves and surplus, and long term sources of finances. So the cost which is associated for the debt, we call as cost of debt. The cost which is associated for the equity, we call it as cost of equity. If we combine all these costs, we call it as cost of capital. Okay, then coming to financial structure. Don't get confused with the capital structure and financial structure. Capital structure refers to, it is the capital which is associated, which is nothing but it is the measure, the extent to which total funds are available to finance the total assets of the business. That is, in simple sense, we can say the capital financial structure is nothing but total liabilities, and financial structure is nothing but capital structure plus current liabilities. We call it as, we can call it as current liabilities. We call it as capital structure. Okay, let us see a simple example that which differentiate between capital structure and the financial structure. See here, here is the balance sheet which consists of liabilities and assets of a company. We have to find out what is the capital structure. Okay, coming to here, we have the balance sheet which consists of liabilities and assets. Coming to liability side, it is having equity share capital, preference share capital, debentures, retained earnings, bills payables and creditors. And coming to asset side, it consists of fixed assets, goodwill, stock, bills receivables, debtors and cash and bank. Okay, this consists of liabilities and assets. Now we will calculate what is the capital structure and what is the financial structure. See, in case of capital structure, it considers only equity capital, preference capital, debenture, retained earnings. That is, the capital structure considers only the long-term sources of a fund. See here, it considers equity capital. Equity is a long-term source. Preference is also long-term source. Debentures is a long-term source, and retained earnings is also long-term source. We add up all the long-term source of funds, so that we will consider the capital structure of the firm. And we will go for proportion. Here is nothing but what is the total of this amount, and what is the proportion of equity capital. See, here we have 65,000 of the total, okay, and we have 50,000 of equity capital. Then we will consider what is the proportion, what is the percentage of money of equity capital out of the total 65,000. Okay, we'll go for simple one. We'll go simple example. I try to tell you. Okay, see here, we will go for the calculation of proportion. That is, so 50,000 divided by 65,000, that is total of the sources, into 100, which gives us 76.92, that is 92, that is portion of equity capital. And then coming to preference capital portion, that is 5,000 divided by 65,000, which gives us 5.69. In the same way, 6,000 by 65, which gives us the proportion. Okay, in simple sense, what I want to say is capital structure is the combination of all the long-term sources of finance. Coming to the financial structure consists of all the liabilities, not only the long-term source of finance like equity, preference, debenture, retained earnings. It also consists of current liabilities such as bills payables, creditors. So the financial structure consists of the total liabilities, whereas capital structure consists of only long-term liabilities. Here also we have add up all the long-term sources of finance, and then we will go for proportion of it. Okay, then coming to what are the objectives of capital structure. Coming to the objectives of capital structure is there are two main objectives. That is, it will maximize the value of the firm and minimizes the overall cost of capital. What are the main objective of this capital structure is? It maximizes the value of the firm and minimizes the cost of capital. That is, the financial manager has to select the capital structure which will increases the value of the firm. That is, its stock value, its share value, the value of the firm has to be maximum, and the overall cost of capital, that is how much of cost which is incurred to raise the capital, has to be that should be minimum. Okay, then coming to optimum capital structure. What is an optimum capital structure? Optimum capital structure is defined as it is the combination of debt and equity. As we know, the capital structure is the combination of debt and equity. The combination must have the maximum value of the firm. We call it as optimum capital structure. Okay, in simple sense, we can say that an optimum capital structure should be leads to maximize the value of the firm and decrease the value, and decreases the, that is minimizes the overall cost of the capital. That is the main objective of the capital structure. Okay, then coming to what is the importance of capital structure. Capital structure determine the risk assumed by the firm. See, here we have to understand what are the various sources of risk, what are the financial risk, what is systematic risk, what is unsystematic risk, what is controllable risk, what is uncontrollable risk. We have to understand what are the different types of risk and how these risks will affect our capital structure. Okay, then coming to the other importance is capital structure determines the cost of the capital of the firm. That is, we should select the capital structure which will decreases the cost of capital. Okay, and it also affects the flexibility and liquidity of the firm. See, the capital structure which we have selected must be flexible. That is, it must be flexible in changing. That is, if you want to increase the debt, we can increase. If you want to decrease the debt, we can decrease. Or if you want to change the equity capital, we can change the equity capital. That is, our capital structure should not be a rigid one, it should not be standard one, it should be flexible and it should be capable of changing based on the requirement of stock market or based on the requirement of the market. It must be flexible to change, and it must be liquidity of the firm. That is, the capital structure should be liquid, it should be liquidity. That is, whenever we want to convert our assets into cash, it must be provide the flexibility to convert our assets into cash. Then it affects the control of the owner of the firm. See, it says that the capital structure should be under the control of the owner of the firm. That is, the capital structure should be under the control of equity shareholders, because the debt portion is increased, we have to pay more amount of interest. If the equity portion is increased, then the ownership is get diluted. So the capital structure must be under the control of the owner, under the control of equity shareholders. Okay, then coming to the next one, that is determinants of capital structure. The capital structure is affected and determined by various factors. The first one is cash flow position. What is the cash flow? Cash flow is nothing but cash inflow and cash outflow. That is, how much of cash is getting into the business and how much of cash is getting out of the business. If you get the cash inside the business, we call it as cash inflow. If the cash is moving from our business, we call it as cash outflow. Okay, we have to consider the cash flow position of the business. The debt capital should be used only if the cash position is really good. That is, we have to use the debt portion if we have sufficient amount of cash in the business, because if we have debt in our company, we have to pay interest. Is it not? Is it not? So if our cash position is good, then we have to go for debt capital. If our cash position is not good, if our company is not having sufficient amount of cash, then we have to go for equity capital. Okay, that is, based on the cash position, we have to select the debt or equity. Then coming to tax rate. Okay, if the rate of tax is high, the cost of debt decreases. The rate of tax is high, then cost of debt is decreased. The reason is the deduction of interest on the debt capital from the profits, considering it as a part of expenses and saving the taxes. See here, if the tax, I will tell you a simple example. The if there is high taxes, people will not go for getting the money in the form of equities. Okay, if the interest rate is high, the people will not go to get for the debt. Okay, that is, based on the tax rate, the capital structure will get dependent. The capital structure is dependent. Okay, see here, if I will tell you a simple example. You are getting 1 lakh rupee of salary, so you have to pay tax. Is it not? For this, what you do? You'll go for some loans. You go from EMI loan, you go for some car loan, personal loan, or some other loan. If you go for loan, what happen? You having debt, the tax is reduced. Is it not? In the same way, the company, if the company is having high tax rate, then company will go for debt debt source. Okay. Then coming to interest coverage ratio. With the help of this ratio, an effort is made to find out how many. Okay. See here, with the help of this ratio, it will find out an effort to made how many times the EBIT is available to the payment of interest. That is, the capacity of the company to use the debt capital will be the direct portion to its ratio. In simple sense, we can say what is the company's efficiency to pay its interest. How many times the EBIT is available? What is EBIT? Earnings before interest and tax. It shows that how many times the company is able to earn, is having the ability to pay the interest. If the company is having the ability to pay high interest, then the company can go for debt source. Okay. Then coming to the next one, flexibility. As we discussed, the company capital structure must be flexible. That is, it is the needed, it is the amount needed of the capital in the business could be increased and decreased easily. That is, our capital structure should not be a rigid, should not be a standard. It must be a flexible. It must be a flexible. If it is flexible, we can increase the capital or we can decrease the capital. Is it not? If it is of rigid one, we cannot do anything. So if we want to change the debt portion, we can change the debt portion. If you want to change the equity portion, then we can change the equity portion. So our capital structure should be flexible. It says that reducing the amount of capital in the business is possible only in case of debt capital or preferential capital. That is, based on our flexibility, we can change the capital structure. Then coming to next one is stock market conditions. Based on the stock market conditions, the capital structure is dependent. The capital structure is affected by the stock market conditions. Stock market conditions refers to upward movement and downward movement in the capital market. As we know, capital market, that is the debt market, equity market. Simply we can say share market. We can say share market, stock market, stock market. As sometimes the stock market is bull market. That is, its stocks are performing very well. Sometimes it is downward market, that is bear market. The stocks are not performing well, the investors are getting losses. Both the conditions have the influence on the source of finance. When the market is dull, when the market is bear market, then investors are not interested to invest in the stock market. If that is in the investors are not invested to invest money in the equities. Okay, if the stock market is performing well, then investors are more interested to purchase the stocks. Now, at current situation, we are facing the financial problem because of coronavirus, that is COVID-19. Because of this, investors are not interested to invest in the stock market because all the stock markets are running in losses. We don't know what will happen. Now we are in the pandemic situation. What will happen in future? The stock markets will run or not? What about the businesses? So the investors are in a fear either to invest or not. Okay. In such conditions, the stock markets will not perform well, then investors will not invest more in the stock market. Okay. Then coming to the next one, that is flotation cost. Floating, movement. We can say movement. Flotation cost is the cost involved in the issue of shares, debentures. That is, if you want to issue of shares, what you have to do? You have to give an advertisement. You have to apply for the SEBI. You have to apply for the company's board. You have to give advertisement. You have to inform to the customers, investors, and we have to go for underwriter, that is banks or any financial institutions. And there are some stationary fees, that is printing papers and all. These cost we call it as flotation cost. Okay, that is the cost which is included in the issue of shares or debentures, we call it as flotation cost. While going to select the capital structure, we have to consider the flotation cost of the business. Okay, then coming to risk consideration, that is financial risk refers to the position when the company is unable to meet its fixed charges such as interest, preferred dividend, payment to the creditors, etc. That is, we have, every company has to pay, compulsorily has to pay interest. If it is having debt, it has to pay preference dividend to the preference shareholders, and it has to pay money to the creditor, that is short term source of finance. Based on the cash position, based on the liquidity position, the firm will select the capital structure. Financial risk refers to the position when the company is unable to meet its financial charges such as interest and preference dividends. Okay, next coming to nature of business. Nature of business. If the business consists of long period of operations, it will apply for equity than debt. I'll tell you a simple example. See, there are different types of products, like fast moving products, slow moving products, or rarely moving products, right? Or there are some companies which is having seasonal products, some companies having regular products. Okay, that is for producing a product, some companies will take lot of time and some companies will take less time. If the companies is having, if the company's production cycle, if the company's the company's product cycle is long, then we have to select the equity portion, because there is no need of payment of interest. Okay, if the company's long, if the company's life cycle, if the company's production cycle is long, then if we select the debt portion, we have to pay interest, and we have to pay interest frequently. Okay, so what I want to say is, if the company's production cycle is long, we have to select the equity portion. If the company's production cycle is less, we have to select the debt portion. Okay, next, size of the company. If the company belongs to large scale, if the company is producing more amount of products, more number of products, it can manage its financial requirement with the help of internal sources. That is, if a company's production is good, if the company is having good amount of production, and a company is having good amount of profits, then it can manage with the help of its internal source, with the help of reserves and surplus. If the company is a small size company, then it has to go for external source of financing, which is of high cost. So the company which is of having large scale of production, it can manage with internal source, whereas the company's life cycle, the company's size of production is small, then it cannot manage with the internal source of funds. Okay, right, next. Okay, and we have the other topic, that is what are the various patterns. Okay, coming to here, we have forms of capital structure. That is, what is the pattern? We can say pattern of capital structure. The pattern of capital structure varies from one company to the other company. That is, based on the availability of finance, based on the availability of source of fund, the capital structure varies. Okay, let us see what are the various forms of capital structure. Generally, we follow for this. We are having 4 different forms of capital structure. First one is equity shares only. Equity shares only. That is, if the company's production cycle is more, or the company's cash flow position, that is, company's cash position is not good, then company will prefer only equity shares, because as the company's cash position is not good, there is no need to pay off interest, because it is completely of equity shares. Or the company's production cycle is long, then the company is no need to pay off interest, so it will select only equity shares. Okay, and then equities and preference shares only. That is, if the company's cash position is good, and it wants to reduce the ownership, that is, dilution of ownership. If the equity shares are more, if there is completely of equity shares, then ownership is diluted. So what it will do, it will consider some portion of equity and some portion of preference, so that equity is not diluted, and will pay fixed amount of dividend to the preference shareholders. And then next one is debt and equity and debentures only. That is, if the company is having tax, okay, if the company is having high tax rate, if it want to go for tax saving, or it want to reduce the tax, what they will do, they will go for some portion of equity and some portion of debt. As the company is paying the debt portion, as the company is having debt portion and the company is paying the interest, so the tax burden is reduced. And the next one is equity shares, preference shares and debentures. That is, based on the requirement and based on the availability of finance in the stock and the capital market, it can select equity shares, some portion of equity shares, some portion of preference shares and some portion of debenture, so that it will make an optimum capital structure. That is, whatever the capital structure you select, the capital structure should minimize the cost of capital and maximize the value of the firm. Those are the different forms of capital structure. Okay, let us see what we have studied up to now. That is, we have gone for what is capital, what is capital, what is the meaning of the capital. That is the money which is required to run the business, to start the business, or the wealth which is required to run the business, we call it as a capital. And what are the various sources of capital, that is various source of long term fund, that is capital, proprietary funds, equities, preference, reserve surplus and borrowed fund, that is long term debt. And what is the meaning of capital structure? It is nothing but a combination of debt and equity, which will minimize the risk and which will increase the value of the firm. And we have gone for what is financial structure. Financial structure is nothing but it considers all the total liabilities, that is its capital structure plus current liabilities. And we have gone for a small problem, how to calculate the capital structure and how to calculate the financial structure. That is, capital structures consist of only a long term source of funds, whereas financial structure consists of long term and as well as short term liabilities, that is current liabilities. And we have gone for what is the objectives of capital structure. That is, the main object of capital structure is to maximize the value of the firm and to minimize the overall overall the cost of the capital. That is what is an optimum capital structure. It is nothing but an optimum. It should not be it should not be high capital, high debt portion or high equity portion. It must be a structure which will maximize the value of the fund, minimize the overall cost of capital. And we have gone for importance, that is, we have to assume the risk and we have to determine the cost of capital, and it has to go for flexibility and liquidity. It affects the control of the owner of the firm. And we also discussed about the what are determinants of capital structure, that is cash flow position, tax rate, interest coverage ratio, flexibility, stock market conditions, flotation cost, risk consideration, nature of the business, size of the company. And we have the other one like legal requirements, requirement of investors, government policies and all. And we have what are the various forms of capital structure, that is only equity, that is completely equity capital, equities and preference capital, equities and debentures, equities, preferences and debentures. Okay, this is the brief about introduction about our capital structure. Okay, thank you. If you have any doubts, you can contact me through my mail or through my mobile. Thank you.